Well, welcome everyone. Thanks for joining our webinar on Bitcoin versus bonds. It's a really interesting topic for all of us. Many of the team actually comes from a pretty deep background in fixed income, particularly Bill and myself, who are going to be on this panel. We spent most of our careers at Guggenheim Partners managing various bond portfolios. So we have experience from anywhere in from treasuries, high yield, asset-backed securities, mortgage-backed securities, plain vanilla, any type of esoteric structure, managing for institutional clients. A lot of our other team members come from a background of crypto only. So we've all come together to talk about where we want to be right now. Do we want to be in Bitcoin? Do we want to be in bonds? Or a little bit of both? To start off, just a little bit about Valkyrie and why this is important. Valkyrie does manage assets across ETFs, SMAs, trusts, and a hedge fund. Particularly in our risk-managed SMAs and hedge funds, we do have the ability to not just invest in Bitcoin, but also in fixed income instruments when we feel like there's a good risk-off environment and we should be in bonds. I mentioned a little bit about our core investment team and our experience already, but as you can see, both myself and Bill spent a lot of time in traditional finance with a deep background in fixed income. Sean and Josh are both crypto native. They have many years of experience trading crypto and crypto instruments. And together we look at the markets in a very interesting way. Myself, I've also been in crypto for a few years, about 7 years now. I've been out here for a little while, but no, we look at things through different lenses and we try to marry our experiences and knowledge to try to create the best possible environment here. I want to get into a little bit just on the basics of fixed income for those that may not understand. In addition to other things, I also have experience as an economist. Spent a lot of my time looking at the bond market and trying to decipher what the macroeconomic landscape looks like through the lens of the bond market. Well, one of the most valuable tools is the yield curve itself. And if you look at where the yield curve has come, in good economic environments, usually you get paid less yield when you're in lower duration bonds and more yield when you're in higher duration bonds or lower maturity versus higher maturity. We're in an environment right now where you're actually getting paid a lot more for holding T-bills. T-bills are instruments that are essentially U.S. Treasuries under 1 year of maturity. So as you can see by the top chart, the yield curve is a bit inverted, meaning you get paid more to hold bonds that might expire in 6 months as opposed to 10 years from now. And that's very problematic when it comes to the economy. Usually an inverted yield curve is signs of a recession. It means that people are generally loading up on bonds with lower maturity, expecting that once those maturities are realized, they can roll into risk assets later. Usually when risk assets are of higher value or that the market expects that risk assets are going to go up and the economy is strong, you're generally holding longer duration instruments because those instruments typically coincide with when a recession will likely hit or when the expected economic cycle is going to either end or start over. So right now every sign points to, number one, recession, and number two, not only recession at the end of the year, but risk assets likely going down, meaning equities. And next, we're going to discuss whether or not crypto will be involved in that as well. Just looking at some of our macroeconomic headwinds here, we've put a lot of things on paper here that everybody can read. I'm going to go off script a little bit and really talk about where our heads are at. So first of all, CPI and overall inflation has been really high for the last 2 years, but the CPI numbers have actually come down. Now that's really due to a couple of things. Number one, there was a recalculation of how CPI is looked at. That's important. But more importantly, what we've gotten is a typical reversion to the mean, meaning that when prices spike, they typically come back and just like a pendulum swings from one side to another and eventually meets in the middle, the pendulum has swung to the other side. So you might ask yourself, well, the other side of the pendulum is 4% inflation. That seems pretty high. Yes, it is pretty high. So that is the outward bound of this mean reversion, meaning that we'll probably see inflation come back into the area of about 8 or 9%, and we'll likely see it, if not by the fourth quarter of this year, but by next year. So how do we get there? If it's simple reversion to the mean, how do we get to higher inflation if we have higher job losses? We have a lot of white-collar jobs that have been lost in the economy due to layoffs in the tech industry, due to the banking industry, in the finance industry, even in stable sectors like accounting firms are laying off several people. So how are we going to get high inflation if people don't have jobs? Well, there's a few factors at work. Number one is petroleum. The cost of oil is really what sends a lot of other products higher. So oil itself has come down to about $70 a barrel. Our expectation is that by the end of the year, oil could get as high as $150 a barrel. There's a few factors at play. Some of them have to do with regulation, and some of them have to do with other economies, particularly OPEC economies, that are going to begin to produce less to send the price higher. And then, of course, you have the supply and demand dynamics within the US. Demand has been extremely high, and you can see that through things like air travel, which has peaked last month. But just as you have higher demand, you also have less supply. So when you have high demand and less supply, typically prices go up. So we expect oil to go higher. The petroleum costs affect a lot of other industries, farming, transportation. So if the cost of food goes up, other types of consumer goods that are necessary are also expected to go up as well as food. So when you have those factors at play, we do expect to see CPI rise. CPI rising in the face of high unemployment for high-paying jobs, as well as we still have a lack of labor supply in areas like hospitality and food service, which also causes prices to continue to go up. So we do expect high inflation, a high likelihood of recession. And by the way, not a recession with a soft landing, a recession with probably a hard landing, which will affect asset prices. So risk assets like high yield bonds, equities, and then I'm even going to put altcoins in that mix. Altcoins, we do expect to act like risk assets. We'll get into a lot more on the regulatory uncertainty later, but there is a lot of regulatory uncertainty right now in altcoins. If you've watched the news, you've seen that Coinbase, Binance, several other exchanges and groups within the crypto industry have been sued by the SEC. And particularly in these lawsuits, many proof of stake tokens have been listed as potential securities by the SEC. So there is a lot of uncertainty in that area. Now, I mentioned proof of stake, proof of work tokens have not been mentioned, and those include things like Bitcoin, of course, and Litecoin. So we'll see what happens there.
Great, thanks, Stephen. Move on to Bill here to further weave in the narrative and how Bitcoin fits into this rapidly rising rate environment.
Thanks, guys. One of the issues we had recently over the last couple of months was just, as Stephen mentioned, some of the uncertainty going on in the macro economy. And this is certainly being reflected not only in the Bitcoin price, but also in what we look at in part of our risk management process of interest rates. As Stephen mentioned currently, and as everyone knows, we're in an inverted rate or yield curve environment. And while that may hold, that was part of the reason, or probably a main reason, a lot of these regional banks felt a tremendous amount of stress and that kind of slight feeling of contagion. We in a crypto community always looked for cash. When we de-risked, we had cash for a moment. We were looking for alternatives or opportunities to put that cash to work when we need it, and to put it in the instruments that we could quickly liquidate and then place back into crypto, back into a better positioned, entry point for, in particular, crypto. Bitcoin, as well as other products. So this is just a slight, Josh and I created this nice brief graph on what the environment has been for us over the last couple of years, which this is kind of our more popular time cycle, where we basically lasted 2022. all the way to the present, where we did see that dramatic move down in crypto. But as you can see, the yields have all gone up, obviously due to the inflationary environment in markets, and we wanted to take advantage of that opportunity. So as I said before, in crypto, we're looking for just, short term. When we risk off, we're looking for short term opportunities, and we found that due to the volatility, due to recent volatility, due to all the debt ceiling issues going on in the government, as well as the persistent inflationary environment, as you can see, the Bitcoin was just all over the place over the last couple of months since April, right? It was up and down 5%. It was almost like a lot of us remembered a lot of the NASDAQ or internet days of the early 2000s. That volatility doesn't really suit a lot of people. And when we were looking for it, we just said, look, we see from a technical analysis standpoint, we see a downtrend with all that volatility. Why don't we risk off for a little bit and place it in very, very short-term discount notes? These discount notes, as everyone should know, is about 1 week to about, we looked out into about a week and a half. So 1 week to about 6 weeks. And as you can see, during this particular time, we were getting paid above, we had a couple positions above 6%. Even right now, they are above 5%. And from a historical standpoint, and even from I would say, young professional life, 5% yields has been very rare, and we have used that to our advantage. So just one particular graph I want to show you is the green graph. And so this is the 1 month and 2 to 3 week discount notes also acted the same. When you had these maturity dates kind of circle around the supposed X date that they were talking about for June 1st, it was a dramatic shift from about 150 basis points. You had about 3.5%, like, maybe like a March 30th paper, or May 30th or May 27th paper. And the June 1st paper, creeped all the way up to about almost 6%, even higher. But one thing I wanted to say was, like, in terms of how we look at risk and how, crypto does incorporate into the overall picture of risk management and risk indicator, as Stephen kind of reflected on, was we do see that Bitcoin right now is kind of drifting along, maybe in a range bound with some volatility. We do see uncertainty in the markets, though. We do see we don't know where the next direction is going. We don't know where this, this bond issuance that happened last week, we don't know how it will be totally reflected into the markets yet. But what we can know is current spreads. And what Stephen and I learned over the last years is that even looking at corporate bond spreads, general corporate bond spreads, in terms of what, in this particular one, it's high yield. So these are double B and below. These are just general indications that you can find on Bloomberg. But we look back at it like from a 20-year stamp. And if you could see right now that the yield to market the market yield is a little bit elevated, probably due to the risk-free environment plus the spread. But the spread is back to pre-COVID levels, as well as historical, and it's right now below historical, or I should say the 20-year limit. In particular, I want to look at the period of the low point before 2010. That's probably closer to 2007. And as you can see, it's a similar environment here. Does that suggest complacency? Perhaps. We could probably see some of this more volatility, and it's probably being predicted. More and more headlines are kind of inferring kind of a higher rate environment for longer. And that might be advantageous. You are getting paid for that risk, but we don't know exactly where those spreads will be. As you can see, the spreads moved up, interest rates moved down, and that's why, towards the end of 2008, at the beginning of 2009, at that high point, almost of a 2,000 basis points, you see that very, very minimal risk environment, the risk-free environment that was held for a number of years, up to even like, the last 5 years. But you see that spreads dominated. That means that it was a very, very high risk environment. You were getting paid at that point. But in terms of right now, where we see stuff, as you can see, like currently, the yields are a little bit, we should probably be a little more cautious on what you're actually getting paid out. That closer to 8 to 10% of this high yield is historically high. It could probably be a little higher, but we're worried about that spread, and we're monitoring that spread from a risk-on environment. And what we see is right now is probably, and what does that risk-on environment mean? For us, it does mean Bitcoin. For us, it does mean other crypto assets, as Stephen suggested, maybe even diversifying to more altcoins. We do see that as a risk-on opportunity. And we always do look at these covered bond spreads on a regular basis to make sure that we're making the right decisions when entering the market.
Let me just make one point here while we're talking about high yield bonds. As you can see, the yield on high yield bonds is about 8%. And if you take out the risk-free rate, what that means is that you're essentially expecting a very low default rate in high yield bonds, but the previous yield curve suggested otherwise. So I would argue that you're not getting paid for the spread, for the small spread that you're getting over the risk-free rate. But the most important question is, why are people, or why is the market paying to get that yield and to take that risk? And it primarily has to do with the largest investors in the world, which are insurance companies, pension funds, and sovereign wealth funds. Primarily on the insurance and pension side, they're not getting paid on their private equity side of the portfolio right now. So they're having to reach for yield on their bond side of the portfolio. So reaching for yield means taking undue risk to get 8 to 10% to make up for lower IRRs in private equity. So that's what's happening right now, and that's what's pushing those yields down or narrowing those spreads is that desire to get a higher yield out of their fixed income portfolio. So you're not getting paid for that. It's a simple reach for yield and a desire to hit the either actuarial assumptions of yield that you need in a fixed income portfolio or the yield that you need in your pension funds to be able to pay your pensioners.
Great. Thank you, Bill and Stephen. Now we'll move on to a quick summary of what's happened sort of since the all-time high here in Bitcoin land from Sean.
Thanks, Josh. Okay, we've heard from expert bond traders, and then Bill just laid the groundwork for how bonds and Bitcoin might coexist in a portfolio. So let's zoom in on the price action and major events over the past 18 months, which is the timeline that sort of captures this most recent period of rising rates. Anything left of where this chart begins as it relates to Bitcoin was during a low rate environment that led into COVID when rates were pushed back towards zero. So with a lack of attractive bond yields, there was plenty of capital flowing broadly into risk and crypto markets. Some were chasing DeFi yields via stablecoins, while others deposited digital assets with crypto lenders, such as BlockFi and Celsius, to try to earn a yield. All this leverage was built up in the crypto ecosystem, and that's where when prices started to come down in the face of the beginning of rate hikes from all-time highs, we started to put too much pressure on those lenders that were way too far out on the risk curve. And as they were forced to halt withdrawals and eventually file for bankruptcy, we also saw the Terra Luna algorithmic stablecoin explosion in the face of volatility and changing prices of collateral. And this all led to October of 2022, where FTX began its historic meltdown. Perhaps where things start to get interesting, that despite the deleveraging that occurred in 2022, it's important to note that the underlying technology, the blockchains, the networks, they remained healthy and operational throughout all this. It was still possible to transact in Bitcoin and use the Lightning Network, for example. Bitcoin miners continued to mine, and in fact, the hash rate has continued to climb consistently to make all-time highs on a regular basis as miners acquire more rigs and turn them on. It wasn't until early this year that the rising interest rates started to impact more players in traditional finance, and so far we've seen that most apparent in regional banks with closures of Silicon Valley, Signature, and Silvergate Bank. Despite the uncertainty over being able to transact at these institutions or even recover deposits during periods of turmoil, and banks are closed on the weekends and holidays. So this highlights the value of being able to directly transact 24/7, 365 on Bitcoin without a middleman or a centralized authority. The pullback in the price of Bitcoin over the course of 2022 can seem rather extreme to some, which is why it is important to understand previous drawdowns and the cyclical nature of Bitcoin's program issuance. The current drop from all-time highs of 69,000 per Bitcoin is very similar to previous cycles on a percentage basis. So these bear markets or crypto winters or whatever you might call them, they typically recover after 1,000 days from the all-time high. And important to note here is that the current drawdown, which on the chart is depicted in blue, has begun to recover quicker than in previous cycles. So this was just a quick summary of the past year and a half. And with that, I'll pass it to Josh to shed more light on current risk sentiment and other technical.
Great. Thanks, Sean. For my seat, my side of the house is really focused on technical analysis and where that fits into being risk on, risk off, and how that affects our allocation percentages. Just to rewind the tape a little bit to the year to date numbers, the beginning of this chart is November. So that's right when FTX collapsed. And after that moment, that was probably the worst sentiment that I've seen. I've been here since 2013, maybe the worst sentiment in Bitcoin or crypto across the board, potentially ever. We've had hacks, we've had exchanges blow up, we've had custodians get blown away, but nothing of that magnitude affecting as many people as it had at that time. Now, like Sean said, at the end of the day, the networks are fine fundamentally. It's not affecting Bitcoin whatsoever. Bitcoin, as we say in the industry, TikTok next block, it's not a big deal. So from a sentiment perspective, it was very interesting at that time that even in the face of that, Bitcoin began to base into 2023. And we had tax loss harvesting as well, contributing to all this, maybe more apparent on some other charts. But into 2023, we had this nice multi-month base, which could be defined in a couple ways from a few different chart patterns, Adam and Eve, inverted head and shoulders, over here, whatever you want to call it, ascending triangle. They all sort of work and operate the same in that you form a base, you form a range, and if you have a bullish bias, you project that bullish bias past the resistance. In this case, the resistance was at that time was around 18,000. So leading into the new year, 2023, we did break above the 200-day moving average, which was also very important. And that's when the sentiment sort of began to soften and flip in that, the dust settled, the dust cleared. And then, of course, we had SVB here in March, a very strong reaction in Bitcoin price coming off of the BTFP program. And then really, as Bill sort of alluded to in the bond section, since April, we've been flat and ranging. And one of the interesting things about technical analysis is that even before maybe these negative news headlines about Coinbase and Binance, we were already leaning heavily bearish in that we were forming, again, a range sort of in the inverse of the year-to-date open. We were forming a bearish range. And we continue to look bearish. We continue to look weak from a technical perspective. We're still up around 57 and 65% year to date, but we still have an expectation of a full mean reversion back to the 200-day moving average, back like we did during the SVB fiasco. And that would also match sort of the previous range. So we like 22, 23, 24, somewhere in there. And that's where we plan on adding risk back to the table. One other thing I'll hit on from a longer term perspective, so that was more of a near term view. The longer term fundamental view is that Bitcoin, as a programmatic supply reduction about every 4 years, there will only ever be 21 million Bitcoin. And the next reduction in that issuance is coming in April next year. So everyone, of course, is thinking about that. And just as we did in 2016 and then before in 2020, certainly, COVID happened right before the Bitcoin halving. And we all know what happened across the board with risk in that regard. But the point of this illustration, this graph here, is that leading into the halving, so this is weeks relative to the halving, leading into the halving, fairly quiet as far as what price does, fairly muted. And we tend to see a positive lift in price after the halving. And as important as the halving is, from a traditional standpoint, just as we finish up here, I think the traditional investor is really focused on three things. They're focused on utility, volatility, and regulation. Volatility is apparent and you have to embrace it. You have to know what you're getting yourself into and be ready to understand the impact, right? So maybe we're not 100% allocated into this high volatility. Regulation, that's certainly coming, and it's on its way, and it's improving, at least in the United States. And from a utility perspective, when we talk about payments, banking, investing, most of us in the Western world, that's certainly focused on investing. In the emerging markets, payments in Bitcoin, stablecoins, that sort of thing is massive right now. Turkey, Lebanon, Ukraine, like Sean said, 365, 24/7, you don't need any onboarding permissions. Anybody can use this network. So I think it's important to understand across the world what utility looks like. Just because we can't go into a Starbucks and use Bitcoin directly isn't necessarily the general importance of utility from our perspective versus the rest of the world. So one last final thing here, just want to hit on some key points. As we've talked about, it's pretty advantageous to allocate certain percentages into bonds, treasuries at this point. Just to blow up Sean's spot a bit, we were talking about allocating our own money as crypto natives, right, into money market funds or treasuries. Bond allocations help shield from volatility, especially in the current market conditions. And again, knowing that Bitcoin is volatile, knowing that it's going to be around, it's the most trusted, most secure as a network. Adding that to a portfolio, potentially using a quarterly rebalancing strategy to harvest returns, shield yourself from that downside volatility, and maybe the headline risk, I guess you could say, as well. And over a multi-year time horizon, again, it's all about volatility. We know, much like I think junk bonds, high yield bonds, that volatility can be embraced and has a spot in a portfolio, certainly. And then lastly, I'll just say Bitcoin's issuance schedule, like I said, is approaching less than that of gold. So from a digital gold perspective, that narrative is certainly solidifying. And with that, I think we will leave it there, unless any final thoughts or questions from anyone. Thomas has a question.
I was wondering if you look at the chart of equities and Bitcoin and look at the move index against that, it kind of looks like the bond market, keeps on betting ever since we basically entered this sort of sideways consolidation or sort of markets, in a range on S&P. Like we got 20% lower, October was the low, and then we're basically in the mid range. So if you take like the all-time high all the way to October down, we're like midway back. But the move index, it keeps on creeping higher. It seems to me like if the bond guys just can't give up, shorting equities and sort of hoping that they're finally going to be right. What would your thoughts be on that? Because I'm under the impression, also I'm looking at on-chain analytics, and I see a confluence that, I don't know, unless something really bad, unexpected happens, I'm more inclining on the bull side, to be honest. What would your thoughts be on that, like on the behavior of the equities, general risk assets versus the bond volatility?
Yeah, so in the bond market, there's both risk assets and then risk less assets. So right now we like the risk less assets, right? So looking at the current curve, we really like T-bills. In particularly, you can get north of 5% in T-bills 6 months or less. So we think that that's a really good value in the short run. And then if you go out to things like high yield bonds or other more esoteric, even mortgage-backed securities, commercial mortgage-backed securities, those would go into the same category as risk assets, much like equity. So those are things that we want to avoid. On the crypto landscape, we certainly want to avoid altcoins at the moment. We believe that there's going to be a lot of regulatory uncertainty around many of the altcoins. Anything that's proof of stake at the moment is in danger. So we're really only focused on Bitcoin. Bitcoin can behave like a risk asset in many environments. Even though we like Bitcoin here, it doesn't mean that in the short run, it might not go down 10 to 20%. But in the range that Bitcoin is in at the moment, we do believe that this is a bottom. And we called that bottom back in December. We continue to believe that's in a bottom trading range for long-term purchases. If you're in it for the long term, it's a good place to come in. Just be prepared to stomach a potential 10, 15, maybe even a 20% drawdown here. But if you're in altcoins, the drawdown could be much more severe. And what we're doing in many cases is we're barbelling Bitcoin with short-term treasuries. So you're getting, on the one hand, anywhere between 5 and 6% for holding T-bills, which at the moment is greater than CPI. And then on the other side, we're really looking for the long term, which is Bitcoin price going higher as we move into the halving and we move out of short-term pain in the current macroeconomic environment. Hey, Josh, can we address one more question we just got in the chat? And that
sure.
is, do we have time for that?
Yeah, sure. I just didn't see it.
There was one mention of short-term treasuries versus cash, and let me just address that really quickly. I would want to be in treasuries right now over cash in almost any situation. There are, I hate to say it, current issues with the U.S. banking system. Just because certain deposits have been bailed out with some of the recent bank failures doesn't mean that they will in the future. So if you're above the FDIC limit holding cash, I still believe that it can be very problematic. And the way that treasuries work is you don't hold that in a bank, you hold that in a custodian bank. And those assets are wholly owned and banked up remote by the person that's holding them. So it is a flight to safety right now. And it's one of the reasons as well that money market mutual funds and short-term treasuries have risen. It's because also the flight of cash out of the banking system and into these instruments for safety. So even outside of the yield, even if the yield was zero, I would argue that I would rather hold treasuries than cash. Given that short-term treasuries are in the 5 to 6% range, I definitely would argue that you would want to hold these over cash, in particularly due to inflation and trying to avoid that.
Makes sense. Great. Thank you, everyone.